Thank you all for coming. It's about the results, so I'm going to do very little of the speaking. I mean, most of you know the company, but not all, so I'm going to just, remind you what we're doing. So I'm going straight into page 2. We're doing a buy and build of scientific instrument companies. We've been at it for 13 years. We bought 16 companies. Why we're doing this? Well, we think it's a very good market to do that because the sector has very good long-term drivers that I will explain in a few minutes. There's a large pool of acquisitions and low working capital requirements. So this is really the model is to buy companies on a moderate multiple of EBIT. Originally, we borrowed quite a lot of money to do it. Now we're more moderate, and because you have low working capital requirement, all your profits go to repaying the bank, and we do it again. So that's a very simple equation, which is really explained in the little chart on the right. And we think that these three things together, plus discipline, are very conducive to creating shareholder value. It's important to have a very good reputation with people who have businesses to sell, and we have one which is really deserved. And to be disciplined and not pay stupid prices or not buy companies you're not entirely happy with just because you haven't done a deal for a while. So really this is the rules we've set ourselves from the beginning. If you go to the next page, you're going to see the deals we've done over the period. It looks more steady than it was because we didn't put in the bad years. Didn't do anything. But you see that you have some fantastic years, like 2016 was our best year ever, where we did 4 deals. But in 14 we didn't do anything. But then we did one in January 2015. So that's the history of it. And they're varying sizes. Some deals were tiny and some deals were a bit bigger. The biggest one, £13 million. And at the bottom of the page shows you a bit the type of clients we have. A lot of educational establishments all around the world, like Cambridge and Harvard, but also quite a lot in China. OEM customers like Thermo Fisher, but we have a lot more, who are other instrument companies selling something which contains our product or for which our product is an accessory, and industrial companies who want to test their products like L'Oreal, but there's many others throughout the world. And we're very part of the 5 Queen's Awards that we've received, 4 of them for export and 1 for technology. So this is a bit the picture of what we're doing. I'll come back to it. Most of you have questions, but this is mostly about the result. So what's the key message of the result? Well, we've had, thanks heaven, good financial performance, good organic performance in the sense that, even without the contribution of the company we bought just about 12 months ago, we would have had quite good growth. We had some production issues in 2016 that we made a lot of progress with that. And we kept benefiting from good exchange rates. Although in the period under review around March, April, sterling tried to recover, but it didn't last. But it did cost us for a period of time, but never went beyond 1.4 or much beyond $1.4. And that's still a very good rate historically, since if you compare when we started the company, we were at 2.04, I think, and we're still making good money. But we prefer when sterling is low. Since the 30th of June, we have continued positive momentum, and we're happy with the order book we had on the 30th of June and the orders we've received since, and so we're hoping to, I'm really believing we're going to beat the consensus forecasts, which I'm not allowed to say what it is, but you can all find out. And I'm passing on to Brad, please.
So, good morning, everyone. I'm going to take you through the key highlights for the past 6 months. And we've had a good 6 months, really strong results. You can see that revenue's up by 13% to 37 million, including organic growth of close to 6%. Profits also progressed strongly, up by 50% to 6.9 million. And EPS also progressed strongly, up by a similar amount to 83.4 pence, up from 54.8 pence in the first half of last year. Order intake momentum continued throughout the first half of the year, and I'll take you through the order intake in a little bit more detail on a slide later. But the organic revenue growth was supported by organic order intake growth, and we finished the first half of the year with a good order book in total of around 15 weeks. In our group, invariably, when you generate good profit, you generate good cash flow. David referred to this a little bit earlier, and we had cash conversion of more than 90% on our 6.3 million cash from operations. This has gone to fund the growing dividend, and the interim dividend is up by 20% to 12 pence. It also funds our focus on reducing net debt, which started the period at 8 million and was down to 2.2 million at the end of June. Whilst we didn't complete any acquisitions during the period, we were able to refinance the group's borrowing facilities, and that put us on a good footing for our buy and build activities for the future for the coming 5 years. So that was a pleasing activity we did during the first half, and then subsequent to the end of the first half, our shareholding in PE Fibre Optics increased to 67.5%, up from 51%, as PFO completed a share buyback in early August. And David will talk a little bit about that later. So, taking you on to performance. As I just mentioned, we've had good organic growth, and this supplemented with satisfactory performance from last year's acquisition, Oxford Cryosystems, giving us good revenue growth in the period. Profits also up strongly, and organic EBITDA is up by 36%. I'll take you through a slide which just shows the evolution of profit in a little bit more detail a little later. Just want to dwell on tax for a moment. Our interim half-year effective tax rate on adjusted earnings is 15%. This is consistent with last year, and we benefit from the UK's R&D tax credit scheme, which helps businesses like ours that invest heavily in R&D and also have less than 500 employees. And for those of you that don't know our P&L that well, we also have adjusting items that take us through to the statutory result. The vast majority of these items are non-cash amortisation of acquired intangible assets, which we're forced to recognise when we acquire businesses. Moving on to order intake, I just want to talk about the graph a little bit. It's a very important graph for us. This is what we keep a very close eye on throughout the year. And there's 3 lines on this graph. There's a red line, a black line, and a green line. The red line is our internal sales budget. And as part of the annual budgeting process, we set this once a year, and that line doesn't change unless we make an acquisition. And the other 2 lines, there's a black line and there's a green line. The black line is our trailing 12 months of orders, and the green line is the last 4 months of orders annualised. And what we're looking for is for the black line to be touching the red line by the end of the year. And that essentially means that if you're looking back 12 months, we know that we've had sufficient orders with which to meet the sales budget. And the green line, we're looking to try and track the red line as best possible, but it is a much more jagged line because it's a shorter term measure. And of course, order intake is also never smooth. So as you can see, the black line has actually very slightly got above the red line by the half year. And so this bodes very well for our ability to be able to achieve our full year expectations in terms of the sales budget. And really, we've had for the last 2 years consistently positive order intake and good momentum in that. And if you look at half 1 2018, we had a very strong comparative that we had to compare to, which was 28% organic growth in order intake in 2017's H1, and then we still this year managed to achieve more than that, which we're pleased about, and consequently enabled us to end H1 with a good organic order book of 15 weeks, which compares similarly to where we were at the end of H1 last year. And since the period end, we've had consistently, well, I say consistent for the 10 weeks at least, positive order intake. Looking at revenue in a little bit more detail, we've had organic growth shared fairly nicely across the UK, the rest of Europe, and also North America. We've also had really good growth out of China over the past years, but it has been erratic, and we've had some very, very strong periods coupled with some dips as well. And whilst when you talk to all our businesses, no one has any concerns about order intake and revenues from China, our revenues from China were down a little bit in the first half. One other thing I want to touch on at this stage is that I think at last results announcement, I talked to everyone about the fact that over the last 3 years, we've started to see in our group a weighting towards H2, particularly in respect of profit generation. Given the strong performance we've had in the first half of the year, at this stage, we're not expecting to see that repeated. So you won't see the same picture in 2018. I want to take you on to the next slide, which is I think a very useful reconciliation of the contribution of the profits from our businesses. That's it. That is excluding central costs and how they've evolved between the first half of 2017 and the first half of 2018. The first column you can see relates to the business where we had some production issues in the past. We've had continued recovery from that in the first half of this year, adding to the progress that was made in the latter part of 2017. So we're pleased with that, and the production is now on a much firmer footing. We've also had pleasing organic growth across our businesses, although as you can see, not all of our businesses are ahead of where they were at this stage last year. And we've also had a positive contribution from Optical Cryo Systems, which we acquired last year. All in all, though, a very positive picture of profit. Moving on to balance sheet and cash flow. As David mentioned right at the beginning, for a business that's in the region of 75 million annual revenues, working capital is only 10%. And so we're very fortunate that we're able to convert the vast majority of the profit we generate into cash. Just want to touch on our defined benefit pension scheme, which we acquired when we bought Armfield at the beginning of 2015. It is a small scheme. It's closed to new entrants, new members. It's closed to new accrual, and it only has around 40 members. And the net liabilities has reduced a little bit since December 17. We've generated good cash during the period with 92% cash conversion, and this has enabled us to reduce our net debt, as I mentioned earlier, from 8 million at the start of the period to 2.2 million at the end of June. We continue to focus on acquiring businesses, reducing debt, and increasing dividend returns for our shareholders. Another key measure we have is return on total invested capital, or ROTIC. Put simply, this is a function of the multiples we pay for the businesses we acquire. So if you start on the left-hand side of the graph, when we acquired FTT, our first acquisition, and we paid close to 5 times for this, we started with a ROTIC of around 20%. And to improve ROTIC, you either have to pay lower multiples for the businesses you acquire and or also improve financial performance. The couple of dips in the middle to right of the graph in 2012 and 2013 are where we acquired GDS and Scientifica on multiples of 6, which obviously is lower ROTIC, brings your ROTIC down, and also Armfield at the beginning of 2015 where we paid 5 times for it. And since the end of 2016, when we had a tough year, we've steadily progressed our ROTIC back up towards a more respectable figure. And in the first half of the year, we've improved our ROTIC from a little bit above 20% to close to 25%. It's still not where we want it to be, and we're aiming for 30% with the group in the way it's currently constituted, and over the coming years, we're looking to achieve that. But you can see some good momentum over the last 2 years in terms of improving that. Just moving on to the diversification slide, just 3 key things I just want to mention about that. One is that you can see that no single company overly dominates in our group. Secondly, that with the number of companies we have, they operate mostly in different sectors to each other, with certainly micro niches within the scientific instrument sector as a whole. And so if one of those is impacted, it doesn't affect the rest of those businesses. And at the same time, when you look at the group geography, No single region, no individual country dominates. So my last slide, as I finish off the financial section, is a look at the history of our group and some of the key statistics that show the long-term success of our group. Revenues, profits and EPS have all grown strongly over the past history of our group. And this period we've had record revenues, we've had record profits and we've had record EPS. And we also continue to have compound organic annual revenue growth of close to 10% over the past 10 years, which is creditable for a business that has a model which is looking at acquiring sustainably profitable businesses. So I think that's an important feature for people to be aware of. Dividends have also grown by at least 10% every year. And this year, no exception, with the interim dividend up 20% to 12 pence. And we continue to focus on cash generation to fund acquisitions, to repay the debt, and also to fund that growing dividend and provide increasing returns for our shareholders. I'm going to pass you back to David.
Thank you very much. Yeah, actually, the dividend compound has grown 24% since we started. So 10% is only for the bad years. I want to go back a little bit to what I explained on growth drivers. Have to understand that the sector we're in, which is scientific instruments, is made of a lot of subsectors, and some are not niche, but some are very niche. What we call very niche is when you have a global market for a particular application where you have maybe one or two or three companies active or in a significant way in that niche. So there are a lot of niches in our sector. Not all our sector is niche. Like, for instance, if you take electron microscopes, you have 4 mega companies in the world, and you have a lot of smaller ones which are still very big. So it's not we don't call that a global niche, but some of our products are very niche, and some of them we're involved in a market. One of the market we're involved has a total world market of 1.3 million a year. So you can compete even if you're not a huge company, which we're not, but we will be. So a lot of global niches. There's 2,000 private companies in the UK only, and maybe I'll explain why we wouldn't have done deals in the UK, but that's already a very big pond in which we can fish for our deals. We believe that a lot of these companies are started when people are about 40 and they leave a big group, or they leave their university to start a business. And then when they're 60, they want to retire, although not everybody retires at 60, but those who do are very pleased. And we think, therefore, that people keep their businesses 20 years. So if they keep them 20 years and there's 2,000, it should be 100 deals a year. So we don't do 100 deals a year, and we don't see 100 deals a year, but we see quite a lot of deals. And a lot are not good. A lot are not in a niche, or not profitable, or don't have enough margins, quite picky, but there's a good pool to work with. The UK is particularly good because people understand how we value businesses on multiples of EBIT. It's more difficult on the continent where people have different ideas, which are usually more expensive. And of course, you have North America, where people understand how we value companies, but they're also more greedy. So this is really the reason, I think, why we've done deals only in the UK. It's not because we're lazy to travel, and we do travel sometimes to visit them, but visiting them and doing a deal is a different thing. So the M&A aspect of what we do is very attractive in that particular sector, but also it's a sector which is very favorable for organic growth. And there is, we believe, 2 main growth drivers. One is a fantastic explosion in higher education throughout the world. And if you think 25 years ago, who went to uni in the UK? It was the people with money or with brains. Today, everybody. So if you think this is happening in the UK, what's happening in China? What's happening in India? What's happening in Africa? So there's a vast number of universities being built, and this is, you know, our main sector constituting our customer base. So this is, we believe, a secular trend which will not change in 5 years, in 10 years, in 25 years. This is a big growth driver. The other big growth driver for us, because we don't sell only for research, and we sell also, you know, for testing products and for industry, is the thirst of the whole world for optimizing everything. Everything today needs to be optimized. So go back 25 years, and you have a son, and he just passes his driving license. What do you buy him? A 1.6 liter car, because he's not going to do any damage to himself or anybody else with that. So what do you do with a 1.6 liter engine today? You put it in a Formula One car. That's what motors a Formula One car. So the progress which is made with that 1.6 liter is absolutely spectacular. And why? Because everything in that engine is optimized, and you can't optimize anything without measuring it. So it is, and it's every industry, every process, everything that people do is constantly optimized. And if you think, you know, why do they launch a new iPhone every year? Well, to make money. But the truth is, this iPhone you buy is much better than the previous one. Everything has been further and further and further optimized, and it means that you have to measure all these things that you've optimized. So that's, we believe, another secular trend which will not relent for the next 50, maybe 500 years. This is the way of the world. So on the long-term point of view, we are in a fantastic sector. And a lot of people ask me this question, when you do a deal, what do you look for? Sustainability. Because, you know, if you buy something, you pay 4, 5, 6 times, and you pay the bank 2.75, you know, it's a no, and you don't have to increase your working capital. It's a no-brainer, you know. So what do you want? Sustainability. That's, if you buy steady companies which are not going to go down, that you don't need that growth. So why do we get 9.5% growth? What's by chance? And the truth is, it's not by chance. And of course, we work a lot on making these companies work optimally. But it's because we have very good growth drivers, and a company which is sustainable in an environment which has inherent growth will grow. It's as simple as that. So we don't take all the credit for their growth. But of course, to improve the growth, you have to always have the best product around, and you have to always do new things, and you have to be always ahead of the game. And so we spend a lot of money on product development, which is all written off. And we spend between 5 and 6% of our sales, which is often a lot more than the businesses we were buying, because these family companies, they're very prudent, and they don't want to gamble their asset, their life, their earnings on being too, you know, entrepreneurial. And this is why they've survived all these 20 years. So we can afford, you know, to be a little bit more aggressive in what we spend in product development. Yeah, always stay ahead of the pack. So I think what I have to add is, you know, I've talked about long-term stuff. Since 2008, I have to accept the world has changed. We're still, you know, paying the bill for that, and we will for still some years. So what's the impact on our sector? Well, what happened after 2008? Not immediately, and not in a uniform fashion throughout the world and throughout the years. But generally, the private sectors, be it companies or households have tried to reduce their debt. And this has transferred the debt burden to governments. And now the government are also trying to reduce their debt. And a lot of what we sell is financed by government. You know, universities, there's a lot of test houses which are national test houses. And so a lot, we reckon maybe 2/3 of our sales are financed at some point by government money. And so this has been more spasmodic. So you have, I think, this long-term secular growth in our sector, and then you have a more spasmodic oscillation around it with ups and downs in different countries. And this is why we've had some bad years since, a couple of bad years since 2008. It didn't start immediately, but since 2012 in our sector, companies in our sector, they've had at various times, reduced demand. When we talk about demand, we talk about solvent demand. There's enormous demand for our product. And if people had all the money they want, we'd sell 2 or 3 times what we're selling. But the question is having funding. So this is really what been, creating a little variability in the short-term picture of our business. So what we're looking for in acquisitions, we want strong exporters because the UK is tiny. So if you're strong in a world niche, well, you have to export a lot. We look at strong EBIT margins. We target 25, but we don't achieve 25 as a group. But 25% means, you're not in a price battlefield. And we don't like to be in a price battlefield, mostly because we're an expensive country to manufacture. And we're looking for companies which generate profit, cash flow. We pay moderate multiples, as I've explained, and we borrow quite cheaply because that's the way of the world today. With a very supportive bank, which has been, key ingredient in the success of Judges in the early days, but still helping us a lot, but we need less help. And after we bought a company, we introduce always very strong, him, strong financial controls. We always need a good MD, who's usually not the guy who sold us the company because he wants to enjoy. And we like an MD who enjoys work, by the way, who doesn't enjoy cruises. So we always need a good MD. We never buy a company without knowing who the MD is going to be. We prefer if they come in from inside the company because the knowledge is quite specific to these niche sectors. And we leave them a good degree of autonomy. We repay debt and we look for the next deals. And succession planning is an important feature, and it's becoming more of a feature because we've had some of these companies for 13 years. And so can't keep, even if we start with a fresh new MD, it doesn't mean he's going to be there for the next 50 years. So we have to up our game in terms of managing successions throughout these businesses and making sure they're run optimally. And so in November last year, we recruited Mark Lavelle, who was at Halma, which is a similar company to ours, or we are a similar company to them, although minuscule compared to them, and have been at it for a long time, but very much with the same management philosophy. And he spent there 17 years, but among these 17 years, for 5 years, he was a divisional chief executive, which is very much the job of the COO at Judges. And so he's been at it for about 9 months, and we're very pleased. We've made, I think, a lot of progress on many topics, and I think what he does will have, a long-term impact on the way the group is run. Outlook, are you doing this or am I doing this? Well, Outlook is good. What influences really us, people are always looking for what do I read in the papers which will have an impact on judges. Okay, currency, currency, very important for us. We've had a, not an ideal period at the beginning of the year, but now we're back to normal, or the new normal post the Brexit vote. So it's very important for us that sterling is not too high, and so we've been enjoying. Government spending has its ups and downs, and the ups and downs. You will have noticed we're doing better in the UK. Since the Brexit vote, we've been warning that we thought the UK would be weak because of government funding, and a lot of it comes from Europe. We had 2 difficult years, but we've had some recovery this year. It shows that people are still doing research in the UK, and clearly they will. It was obvious always that they would. But it's nice to see a bit of recovery there. But of course, there's other countries which are also saving money. So, but we're quite diversified, so we can cope with that. And when we have a bad year, it's not like, having talks with the banks. This is not the kind of bad that we have. We're not expecting, the second half to be like we've had in the last 3 years, a lot better than the first half, or not even equal. We're not saying anything about that. I think what we have to say, last year we had quite a strong bias. We have to remember the last year was a recovery year from 16, which is a bad year. And of course, when you have a recovery year, you get a lot of orders that you don't deliver immediately. So we had a lot of orders, enormous order intake in the first half of last year, which was up 28% compared to the previous year, organic. But not all of this was delivered immediately, so a lot of it was delivered in the second half. So part of the bias for last year was the fact it was a recovery period, and we're not in a recovery period. And after the year end, we've had we were happy with the order intake the first 10 weeks. We started with a good order book, so we're happy, and this is why we, think we're going to beat our forecast. So why should you buy Judges shares? Well, first you should have them already, but why should you buy them? Well, the growth drivers, absolutely. A very robust business model, which is easy for anybody to understand. It's like, a child would understand it. It's pursued with discipline, so that's not for children, We are of the marshmallow kind, and particularly with deals, If we don't like the marshmallow which is on the table, we'll wait for the next marshmallow. A large pool of targets. We only do earnings-enhancing acquisitions. We only interest in shareholder value, which is driven by profits, cash, repaying the debt, growing dividends, and achieving good return on capital. We believe that the shares are free of IHT if they've been held for 2 years. We don't see, I say we believe because we're not allowed to say they are, but we don't see why they would not be. And we have a good degree of diversification between different countries and different disciplines of science. And yeah, so we think they're good shares to have. I have some. And of course the dividend growth has been, we believe, a very strong way to make money with shares without needing to sell them. Questions? We're open to questions.
It's a fantastic year again, half year, well done. Excellent. The debt you've reduced fantastically from 10 million to 2 million. And you, at the same time, you built up the firepower. You've got 35 million facility. And so the fact that you haven't used it, do we take it that businesses are too expensive at the moment?
No, it's not. We don't see that what you have to pay for businesses changes a lot over time, except that in 2009 everything was very cheap. So there was a good period, but I can't say businesses are getting more expensive or less expensive, but they come like buses. So, you know, sometimes you have a lot of deals that you really want to do, and sometimes you look at a lot of deals and you're doing a lot of work and you just can't harpoon them, and that's life. So yeah, it's erratic, but we can't see that there's a trend which is not good. One of the things we have to say is you have 35 million, but if we want to spend the 35 million in one lump, we'd have to pay a lot more than the multiples we've been paying. You know, if we want to buy seriously large businesses, you're competing with a big boys, and also private equity. Above £1 million EBIT, you're competing with private equity, and sometimes they're paying. There's one business I was looking at, just to give you an example, in Canada, which is not a very big business. It's about £1 million EBIT prospective, and it was sold to a private equity house for 3 times the indicative offer that I had placed. So it just gives you an idea of the impact of private equity on these businesses if they're more than £1 million EBIT. Below, we have more peace.
And one other thing is that 2016 was the only real hiccup in the great growth you've had over the period. And have you learned from that? Are these external factors outside your control? Could it happen again?
Well, I think in 2016 we said we had 2 companies which suffered from poor demand. The problem was we had 3 big companies faltering at the same time, so it was really tough. One, we don't even know what happened to the market, and it's a company which does OEM business, so they basically sell an accessory which to sell it you need somebody else to sell a much bigger piece of equipment, which is very expensive, and for some reason demand was solvent demand was not very high during that period of time, so nothing we can do about it. Another company, we specified which one it was Armfield, does a lot of business in less developed countries, and it suffered from low commodity prices and oil, which is a big source of finance for less developed countries. Not much you can do about this either. In the short term, you can always exit the business, shrink it, etc., but demand is demand. And of course, both have come back to normal. So that's can't do anything about it. But we also said we had production problems in one of our companies, also a large one, and that you can do something. It is self-inflicted, I have to say. We didn't do a good job. It's upsetting. It's the first. You always have production problems everywhere. There's not one month where we don't have issues somewhere, but one which takes this magnitude and which has required a complete change of management in that company. Yeah, it is something you can do something about, and we did.
Can you so kindly explain your export business model, given that a major constituency of your customers are universities, and there are thousands and thousands of these universities? You mentioned China. How do you cover all these universities? Do you lock into a central distribution network, or do you go and see these individually?
No, it is largely distributors. Yeah. In Europe, we work a lot direct. But in China, we always have distributors. I mean, they're building 1,000 universities, which is enormous. So you can't, and our distributors are, they have several offices, but we have different distributors for different businesses because they address different disciplines. And sometimes you sell to the same university through different agents because they're different products which address different needs. But yeah, in mostly outside Europe and the States, we usually sell through distributors or agents. But I have to say that there's a lot, and particularly where we don't have an agent, but a lot of business comes to us because as I explained, they're very niche products, and sometimes, you know, people go on the internet and they find us, and so they ask for quotes. So sometimes it's a bit less proactive than one could think it is. You know, and also I think you have to see the viral effect of teachers moving around universities. And, you know, the UK has been a big magnet for students, particularly you mentioned China. There's a lot of Chinese come and study here, and then they take a job with a UK university and they use our instruments, and then they go back to China and they have, you know, they become big professors there. And what they remember is to work with our instruments. So that's also an impact, and then you don't need to do proactive selling because that's what they want to buy.
During your presentation, you mentioned that there was a bank that supported you and you were appreciative of their support in some of the early times. Do you find that in today's environment, you have to give them an extra level of engagement to keep that goodwill, or do you think that?
Not at all. We've worked closely with the bank. I mean, David's worked with the bank for longer than he's been with Judges. But, you know, we've a very close relationship with them. We're very open with them. We give them good, regular information, and they're very, very supportive of what our plans are. And every time we've got a deal that's in the pipeline for us, we talk to them about it. They understand. You know, and they're very, very supportive, and they're very keen to lend to us because we've got a great track record. We're continuously profitable. We generate cash, maybe more cash than they'd like us to generate, in fairness, because, of course, they'd like us to pay a bit more interest. But that's a positive for us. But they've been very, very supportive and continue to be so. Don't see that changing.
Can I ask you said your goal was to get the return on invested capital back up to 30%. Is that, I just wonder what sort of target that is, in the sense of if you're doing more acquisitions, that's obviously going to be dilutive to that. So is that X?
Yeah. You know, of course, you could say it's reached at 1.46%. So, you know, why don't we want to do 47? But it's true that as we get bigger, you know, we have to accept that we're going to do more deals where we pay a bit more than what we paid in the early years. And also, there was a period in the early years where, as I've explained, the sector was just on and up. You know, and everybody was doing well, and never anybody had a bad year. And when you have a bad year, you pay for a period of time. It's not just immediate, and then it goes when it goes. So you have to convalesce. So why did we start thinking, you know, in 16, well, we have to get back to 30%? Because if you took out the companies which had a problem, that's where you were. So, you know, having bought what we bought at the price we bought, you know, you just need to get these companies back into a normal shape to get to 30. So it's not like an aspiration which comes out of nothing. It's like, you know, sort out these 3 companies which had problems. Some of them, as I said, we can't do anything about them, and some we can, and then that should get you back to 30%. So that's the aspiration we have. It's not a forecast.
It's not a forecast, and it's not an aspiration in the sense of it's going to affect any timing of any deals or thinking.
No,
will dilute.
And frankly, to be honest,
you
know, if say we were 29%. And we have a nice deal, you know, but you have to pay 6 times for it. We're not going to say, no, let's get to 30 and maybe the deal is still there. It won't be.
Can I mention the B word? In terms of, obviously, you know, lower sterling's good for you because you're an exporter. Do you see Brexit or bad Brexit or whatever having effects on how you sell, particularly into Europe?
Yeah. Okay, and we don't get into any politics here. So I didn't vote, by the way, because I didn't have a passport at the time, so I didn't vote in that particular vote. Now I have one, but I'm dual national. So, you know, for us, these are the issues with Brexit. First, currency. So the worse the deal or the perception of the deal, the better for us because sterling goes down. So, you know, some people ask me, what if there's a no-deal Brexit? Well, sterling will go down more than if there's a checkers deal. If there was another referendum, you know, probably sterling will go up a bit. So that's for us very important. That's a direct impact on although we do some hedging, but it has a direct impact on us. Secondly, there's a question of financing of research. A lot of financing comes from Europe. The government has promised that, you know, post-Brexit, there would be so much more money to spend that it will be spent on research. I'm sure they will support research. I'm not sure whether there will be so much more money, but I'm sure they will replace to an extent the money coming from Brussels. There's other things, of course, than just money, but there's partnerships. You know, often, you know, you have a university that does a lecture in one university, does a research project with another one. And it's true that, you know, if you're sitting in Heidelberg or in Bordeaux and you want to choose a partner in a piece of research, you're not necessarily going to choose a British one at this point. But we shouldn't get, you know, extremely anxious about all this, because you have to remember that the UK universities have a lot of partnerships with universities which are not in Europe. I mean, it's not only Europe which has universities. But this will have an impact, and probably a continuing impact, and we've paid the price the last 2 years in the UK. Now we're recovering a bit. And then there's a question of access to markets. Well, the worst, of course, is the no-deal deal. And if there's no deal, well, back to WTO, which is the basis on which we do, most of our business is done on that basis, although a lot of countries exonerate products which go for research or teaching. So, you know, but we deal quite freely with China. Most of what we sell to China doesn't pay duty. A lot of what we sell to the States doesn't pay duty. And so, yeah, Europe will be like that. So we're not super stressed with Brexit one way or another. We're a very international business.
My last question is, you mentioned the 1600 cc motor in your presentation. Things are changing dramatically in the AI sector. Do you see a risk of this change accelerating to such an extent that one of your main businesses may become obsolete and redundant, in that there would be no longer any need because it's been supplanted by an progress in AI?
At this stage, I think if you look at the normal way you see evolution, then you know, you're right, there may be a risk, but because we operate in small niches, coming in as a new competitor in one of those niches is not a hugely profitable exercise. And there are so many larger sectors, industries, whatever you want to call them, for this to aim at. I think that if it would happen, it'll be a long way away. Because if you've got a niche that is generating a few £1 million of sales, how much time are they going to spend on that versus the multi-billion ones? If and that's the big if that's coming, I think it's a long way down the list. Right. So in the meantime, yes, there are improvements in technology everywhere, and we're keeping a pace with that. You know, it's one of the key things we do when we're looking at future businesses to acquire, which is, you know, the risk of technological change. And we can use an example like the business we bought a couple of years ago called QLED, which is an LED illumination systems for fluorescence microscopy. And what they do is supplanting old mercury lamps. Now, it's a great business, mercury lamps. They're incredibly profitable. they're not that good at what they do, and LEDs are now a lot better, and they're coming in and slowly but surely they're replacing them. That's technological change, and we're clearly very, very careful at looking at that and trying to make sure that when we are about to press the button on an acquisition, that we feel confident that there isn't any soon to arrive technological change. And at the same time, for the businesses that we do own, we're encouraging them through R&D to continue to develop the products they have, to improve them, maybe come up with a brand new one that replaces the old one as well. And I think that's important for us. We're always looking over our shoulders. We're certainly not coming out with the comments like you get from the likes of, or you had from the likes of BlackBerry that said, don't worry, it'll never happen to us. For us, we're always concerned about it. For us, it's very, very important that we continue to challenge the businesses to ensure that they are keeping their products fresh and in front of their competition and looking over their shoulders. And you know, we have a lot of people that have PhDs and those research departments, and they're out on the road as such, going to conferences, understanding what other changes in technology are coming along, and are looking to move our products further forward. So I think we're well placed. We're absolutely not complacent about it, and we never will be.
R&D is so important these days because things are changing rapidly. And is there any scope for kind of centralizing the R&D for all these businesses?
No, really not. I mean, one company called Electron tried to do that, and they put everything in there. They had a beautiful building in Cambridge that I visited, and you know, you had a window like this from the boardroom, and then suddenly they open, you know, all the curtains, and they show me this is R&D. So there were a lot of beautiful desks, all were the same. It was not populated yet, but they were going to repatriate to Cambridge all the R&D for a group which was probably more diverse than us. But you know, when I visited, I was really intimidated because I think we had a market cap of 6 million and they had a market cap of 50. And you know, then they went through a phase where they had a market cap of 5 million after that. And it really was not a solution. And the reason is that R&D has to be close to the people who will sell the product. You need to be the best R&D is generated by a salesman who goes to see a client and he say, "Oh, that's what we need to do."
But you actually have a building, your own building, one or two businesses.
No, but I mean, it's always local.
That's separate business.
It's always local.
Yeah.
The R&D is always local to each company.
Okay, if anyone doesn't have any other further questions.
I have one thing.
Please.
You were talking about 10% annual compound growth. And then you said that's in the bad years and it's 24%.
Yeah,
but 24% is the dividend.
Yeah, no, when I was alluding to the dividend growth, yes, that we're trying to establish a record that we always pay at least 10% more every year. And the reason for that is when I was in business school many, many years ago, we had an excellent finance teacher, and what he taught us, and made a bit of sense, is that the value of your shares is really the discounted value of all the future dividends. That's the value of your shares. Or else is what you can get by selling them. But the intrinsic value is not what you get by selling them, because the guy who buys them, he also wants something. Of course, in those days, you know, shares did pay dividend. You didn't have companies worth, you know, $1 trillion who didn't pay any dividend. But that's stuck with me. And I felt, you know, in the area of low interest rate, if you pay always 10% more, the theoretical value of your shares is infinite. We don't aspire to that, but it would be nice. So we think that as a valuation tool, a growing dividend is a very important feature. So we're really trying to increase it by 10% a year, but often we've increased it by more, and the result of this is we have, if you look from the beginning, we've increased it by compound 24%. So it's a lot more, but we try to always keep it well covered so that we have a good visibility that even without growing the company, we could still grow the dividend. And I think last year we calculated at the year end that we could increase the dividend 10% for 14 years without growing the profit, and still it will be covered. So we're trying to keep a good balance.
Thank you very much, everyone. Appreciate you coming
Thank
today.
you so much.